So, this golden toilet metaphor, do you have a recent story where that fit in really well too, other than the one that you shared?
Yes. There are, unfortunately, or fortunately, I've got a lot of these stories. The life insurance people think I pick on them. Maybe it's because I do. And again, it's not about the individual. There's a systemic issue. So dealing right now with somebody that is not financially knowledgeable, a widow. And she collected life insurance proceeds. And now she has a lot of investable assets. And the question is, what do you do now? What do we do with these assets? And so her go-to person is a life insurance agent. And he is advocating take all this money and put it into life insurance policies. And, the pitch goes like this. Put the money to life insurance policy. It's a cash value policy. The money that's in the policy, your cash value is going to grow. And that is tax-free growth. And when you need money from the policy, you can pull out that cash as a loan, which will be non-taxable. So life insurance is kind of the be-all, end-all, one-size-fits-all solution to all your financial needs. It provides a death benefit, provides investment, it provides everything. That's the pitch. Now, the hardest thing to combat is things that have, that are partially true. But I think the way that I'm thinking is the most effective way, just people's attention about this is, do you think life insurance companies, and then we'll get to what the alternative is, right? And I'm not saying the alternative is the way to go. The problem here is that the life insurance people are presenting a golden toilet, which is kind of you buy this ticket and then you're set, when there's room for a lot more nuance with far, far better outcomes. So life insurance companies don't have printing presses that print money. They're not giving charity. Where do you think they get their money from, right? When they give you money, where do they get it from, right? So they take in your money, and they're making profit for themselves, right? They're paying the insurance agent 100% commission. The first year's commission is usually all that you pay in. And then in some states, it exceeds that. I'm in New York, which puts a cap on that. So the insurance agent can only get 90% of the of the money up front. Other states are getting 110%. And some of these policies are very expensive. People are paying hundreds of thousands of dollars per year in premium. So the insurance company took in a couple $100,000. They gave it to the agent. They're paying out death benefits. You get what's left, right? It all comes from the policy owners. There are no miracles here. There's no printing press. They take the money in, they invest it, they pay their expenses, and they give you what's left. So it's highly unlikely that this is the best deal in town for you, because what they're doing is they're giving back your money, and your money is yours, and really it means collectively policy owners, minus their expenses. So it's just impossible that this is the most efficient structure. So in this scenario, we're talking about the widow. Maybe she's not so objective because she actually got a payout of the death benefit, right? So there was a policy on her spouse, and he passed away unexpectedly, very young, and she collected millions of dollars. But nobody buys a life insurance policy as an investment thinking, hey, let's buy this policy and then kick the can next year, and then listen, I only paid $100,000 in premium, and now my beneficiaries will get $2 million. That's not the plan. So we have to kind of put that aside and say, let's just look at the pure investment fundamentals. And in most scenarios, once you have the fundamentals in place and you understand, hey, I'm not planning to die tomorrow, right? And unless somebody knows that they have a terminal illness and are committing insurance fraud, the insurance companies know your health, right? They have armies of underwriters whose job is to assess and to make sure that we're taking in more in premium than we're paying out in death benefit, right? So you're not dying. You're not making money that way. You're not monetizing the policy by dying. So you're going to put $100,000 in premium into this policy. You know how much cash value you're going to have tomorrow? It can be done a couple of different ways, but you're going to have a lot less than $100,000 in there in your cash value. You may be $5,000, maybe $10,000. Technically, it could go as high as $85,000, depending how the policy is structured. But that's a lot of expertise to determine the best way for you. So what will normally be the better way to go is to consider some form of investing, like real investing. Don't give it to the insurance company so they can pay expenses, they can invest it and make profit and give you the leftovers. Invest it yourself and see what that returns you. And then when you compare and try to approach it from a multidimensional perspective, you're going to arrive at a whole other suite of options. That's not one size fits all, but again, you'll explore bonds, stocks, mutual funds, and how to do that. But what we have now is the life insurance person's promoting this golden toilet, which is not in this widow's or anybody's best interest.
Hey, thanks for watching these golden nuggets. And as a reward, I got another big fat golden nugget just for you. I wrote this book for you to help you get your act together online so you can grow your business better. You're searching, you want to learn. This is a great book. Grab the book, grow your business.
Amazing, right?